Shares of Tesla plunged to a fresh two-year low on Tuesday as the embattled automaker, already reeling from concerns chief Elon Musk has shifted too much focus to Twitter, reportedly faces a prolonged shutdown at a key factory next month, and broader skepticism the electric vehicle industry can meet lofty sales expectation as COVID-19 outbreaks pummel demand in China, the world's largest auto market. In today's video, we will be showing you why Tesla stock is crashing. Without further ado, let's begin. Tesla shares tanked 11.5% Tuesday to $109, the lowest level since August 2020 and a stunning 73% decline since a high of more than $400 in November 2021. Losses piled on in pre-market trading immediately after Reuters reported the firm plans to cut production at its Shanghai factory in January, according to an internal plan that purportedly reveals the automaker will operate between January 3 and January 19, and then halt production for the rest of the month to observe the Chinese New Year. Tesla, which disbanded its communications team in 2020, did not comment on the reports, though they come as the firm this weekend extended a planned 8-day production halt at the plant, which is the company's largest by car volume, in response to a growing wave of COVID-19 infections in workers and suppliers. In emailed comments, analyst Adam Crisafulli of Vital Knowledge Media called the news only the latest in a series of cautious headlines about Tesla, noting the company last week rolled out a $7,500 discount, double what it was offering earlier this month, for its two most popular models in a bid to help bolster end-of-year demand. Further fueling pessimism, rival electric vehicle maker NIO on Tuesday morning warned it has been facing challenges in deliveries and production as a result of COVID-19 outbreaks across major cities in China this month, and slashed its projected fourth-quarter deliveries by some 15%, sending its shares down 8%. As the market transitions to more sensible valuations, there are less and less reasons to be bearish. The beginning of a recession often signals the beginning of a new bull market. I'm still not bullish on Tesla, nor the S&P 500, but I wouldn't be short, and I wouldn't be sitting on a pile of cash at a time like this. Jim Cramer often exclaims on CNBC, "There's always a bull market somewhere." This is by no means an endorsement to take advice from Jim Cramer, but I believe there are plenty of contrarian values to be bullish about as the market shifts from what was to what will be. As for Tesla, I'm not a buyer yet. In my base case scenario, I'm seeing long-term returns of 5% per annum. Tesla's outlook. Legendary investor Sir John Templeton once told Bill Miller the following: "There are only two types of investors, those who are outlook and trend investors, and those who are price and value investors." 90% of people are outlook and trend investors. A year ago, the outlook for Tesla was phenomenal. The company was demonstrating explosive growth, and that growth was expected to continue. So far, it has. Tesla's net income has soared. Despite this terrific financial performance, Tesla's stock has plummeted. So what's going on here? Well, like Sir John Templeton said, 90% of investors are outlook and trend investors. What happened was, the outlook changed. Elon's diverting his attention to Twitter, a recession looms, and Tesla's market share is shrinking. These are all things I warned about 5 months ago. They're coming to light. As for the market share, Forbes said it best: Tesla continues to dominate EV sales, with 65.4% of the EV market. However, that is down from 68.2% in 2021 and 79.4% in 2020. With the market growing, Tesla is still rapidly growing its vehicle sales despite its loss of market share. That's U.S. market share, by the way. Globally, Tesla has an EV market share of roughly 14%. Another issue for Tesla is that every automaker globally now wants in on EVs. And of course they do. EV stocks have soared, and traditional automakers' stocks haven't. In addition, Tesla's displayed remarkable profitability selling EVs. This is simply how capitalism works. When an industry gets hot, everyone rushes in. Once everyone's rushed in, the profits get squeezed because there's more competition. Now, looking at Tesla, the company maintains the premium product. Tesla's customer satisfaction scores are industry-leading. Tesla had a first-mover advantage, and its technology is just better at this point. Elon did a terrific job of building Tesla's brand in a brutally competitive auto market. One thing to note on the customer satisfaction scores: that's just for EVs. Newsweek recently found that buyers of internal combustion vehicles are more satisfied than EV buyers. The world is still developing the infrastructure necessary to make EV road trips a seamless experience. That process will take time. Despite this, the EV industry will continue to grow. Tesla's future growth: the number of electric vehicles sold globally is projected to grow at 17% per annum through to 2027. Tesla has an opportunity to grow its autonomous drive, EV semis, and energy generation businesses at rates exceeding 17%. But because 95% of Tesla's revenue comes from the automotive arm, where Tesla is losing share, I expect the company to grow its earnings at a slower pace. The other issue I'm seeing is the cyclicality of the auto market. All things considered, I'm projecting earnings to grow at a pace of 15% per annum from here. Long-term returns: my 2033 price target for Tesla is $208 per share, implying a return of 5% per annum. Tesla has earnings per share of $3.23. If it can grow that at 15% per annum, it will earn $13 per share in 2033. I've applied a terminal multiple of 16x. Does Tesla's collapse signal a new bull market? A recession in 2023 is now baked into the consensus. Globally, the world is already beginning to experience rolling recessions. At the same time, investors are exceptionally pessimistic. This usually means it's time to be contrarian and go long. All of the billions of dollars that have flowed out of Tesla stock have to go somewhere after all. An excessive bust is coming, why I expect the pessimism in the technology sector to be more prolonged. After a 15-year stretch, earnings tend to catch up to valuations, and industries have time to fully consolidate. Rather than looking at stocks that have gone to the moon, I'm finding opportunities in stocks that have gone nowhere for 15 years. This was the case for Microsoft, MSFT, in 2013. I believe flat indexes and stocks are now great hunting grounds for the next bull market. The key is that the fundamentals are in good shape. You don't want to buy a company that's about to go bankrupt or become obsolete. As for the market as a whole, I'm seeing returns in the range of 5% per annum for the Vanguard S&P 500 ETF VOO and SPDR S&P 500 Trust ETF SPY. So guys, let me know your thoughts down in the comments section below. For more interesting content, give this video a thumbs up and don't forget to subscribe to the channel for more awesome content. Have a nice day, and I will see you in the next video.